Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app. Wednesday. What are you laughing at?
Sorry.
Don't worry about it. Don't worry about it.
Making fun of me. February. Now I feel bad. It's like the people that when the NFL teams get in a huddle, the people that are really whatever, they think they're talking about them. Like, oh my God, are they talking about me or her type of thing? You know what I'm saying? So I feel like now that you two are talking about me.
You were going to say it's Wednesday. What?
We really
it's
were.
Wednesday.
I was going to say it's Wednesday, February 12th, 1 o'clock on the East Coast. It's Guy, it's Elizabeth, it's Dan, market call. But now I'm forlorn. I'm just kidding. Hello, everybody. Dan, how are you?
I'm doing great. This is I was going to say a big day in the market, Guy. You and I were chatting at 8:33 a.m. and things were going a little haywire there, Liz. And now things. But what did I say to you by like 9:45?
You said to me, you said it's not accelerating. The market's probably going to close higher, and the S&P is basically flat. Which, we might as well start with the story of the day as we get into it. We'll try to keep it tight today. That came in the form of the CPI, and again, we play this game on fast money, Dan, all the time. If you had told me yesterday at this time what the CPI number would be, the year over year, all those different things, given what we've seen in the broader market, given the strength of the S&P, okay, where's the S&P going to open? Down 85 to 100 handles. Didn't happen. And here we are, as I just said, flirting with unchanged. So your thoughts, and then I'd love to hear what Elizabeth has to say about this inflation data.
Yeah, I mean, Liz, I think that a lot of people thought that we'd probably come in line, right? And therefore they kind of have a muted reaction. We know that the CME Fed Funds future has only been pricing, and I think you said it Monday on the tape. We have basically two cuts priced in, and it seems like those are kind of going away a little bit. But at the end of the day, I think a lot of investors, if we just look at this bull market since the lows in 22, they got pretty comfortable with the fact that interest rates are going to be higher. You know what I mean? So like manage your business in and around that. And we've seen lots of different pockets in the economy and the markets, just do fine in that environment. And so I guess the last piece of the puzzle is really all the uncertainty. It was interesting. I was watching Squawk Box this morning. I don't know if you're catching that, the back and forth between whose fault this is and the tariffs aren't even in place yet and this and that or whatever. So at the end of the day, the likelihood that rates go lower, it only happens if you have a situation where the economy is weakening dramatically and employment is a real problem.
That's right. And we certainly don't want to be in that position, right? I mean, seems like the market right after this print was rooting for rates to go lower. It didn't like it. We saw treasury yields shoot up and frankly, treasury yields have stayed up. Those have not come back down, despite the fact that stocks seem to have recovered almost all of their losses from earlier today. But the other thing that we've mentioned before is if we're trying to compare this to last year, you can't really compare it. We came into this year only expecting 2 cuts. We didn't have a lot to give back. Last year, we came into the year expecting 6 to 7 cuts. So the repricing was huge, and we needed to reprice all of that as inflation prints came in hotter. The other thing, and I'll talk about this from the note, so I won't spoil my own punchline here, but the other thing is that this is the first reading of the year, and we've talked about the differences between the beginning of the year and the end of the year. So far, I think the market is interpreting this, aside from in the bond market, I think the market is interpreting this as, okay, we don't love the print, but let's just wait and see. And the other thing that I'll mention, I don't remember if it was a couple weeks ago or last week, we talked about, I believe, the PCE and the idea that could it be a market moving event? And I talked about, I don't think it was a market moving event for stocks, but that any inflation prints from here on out are going to be more volatility inducing for bonds, and that the bond market is the place where we're going to see most of the reaction. And that's definitely what's happening today.
Yeah, and I think we'll put that chart back up, but the TLT chart to me, Dan, really, I think shows the real story of what's going on here. So that's the 10-year yields. We talked about the bounce, but we had been talking about this downtrend in the TLT since September. The fact that when we troughed in yields about 3 or 4 days ago, we basically traded right up to the third point of that downtrend line. And here we are. And I think this one, to me, might be one of the more interesting charts around. So you can see the line that we drew, what we thought was going to happen sort of did happen. And now here we are sort of moving lower in a meaningful way. I'll say again, I'm one of these people, and if Amanda can sort of go out a little bit longer, I think we're going to go and take a look at the levels we saw last fall, which is about 82 and change-ish, which probably suggests, I don't know, 4.9 maybe or so in the 10-year. And then we're going to see what people start to think about the broader market and what rates really mean, Dan.
Yeah, and I guess that if we see, Fed rate cuts priced out for this year, you're going to have a 10-year easily above 5%, right? Like let's just be clear on that. And so then the idea is, okay, so where is inflation? How embedded is it? At the flip side of that, I'm looking at a headline today, Guy, that Chevron is going to be cutting up to 20% of their workforce. This is a company that employs 47,000 people. And so you tell me, like, where does that come from? And it's one thing if Meta is cutting like the lowest, 4% of employees or something like that equals, a few thousand or something. It's a lot of jobs, And so I wonder, we had Jeff Richards on the Risk Reversal podcast. He's from Notable Capital. We were talking about generative AI and the kind of intermediate term promise on the productivity front, and in the immediate term, you could see how lots of jobs, get kind of displaced. And when I say lots of jobs, are we talking about tens of millions? No, we're talking about, maybe, single digit millions in the next few years. Maybe that's coding. Maybe that's a whole, consumer relations and, all that sort of stuff. I don't know. But like, that's the thing you really want to keep an eye on, because back in 2022, do you remember we had like a tracker on all the tech companies that were firing people? And there was like, these things were going around. So I think those are the things you want to worry about. But at the end of the day, and maybe I'll just kick this to you, Liz, I mean, has the Fed put themselves in a bit of a box here? Because the traditional tools to kind of stimulate an economy, if you start seeing weakening employment and weakening data, it's not going to work in an inflationary environment.
Well, it'll work to drive inflation even higher, right? And then we end up in stagflation. And just to put some more numbers around the Chevron thing. So if they lay off 15 to 20%, that would amount to about 9,000 employees. So is the Fed in a tough spot? I think maybe not yet, but this certainly has the makings of it getting that way. So the other thing that I think is important to keep in mind, we talk about all of these readings on a monthly basis, and we look at it as, okay, what was the reading this month? We're worried about what it was compared to last year at this time and what it was compared to last month. The Fed looks at it over more of a rolling period, so a 3 or 6 month period. And so far, I mean, yes, this is definitely a hot read. I remember what they said last year when we got hot readings for December, January, February, March. They said we need to see a trend of these increasing prints in order to get really concerned. And then there was a trend. And at the time, I don't remember if Jerome Powell said it explicitly or implied it, that a trend to them was at least 3 months of data. So we can't react to this in a 1 month period. This is another. Now we'll go to the note. Great. Thank you. Good segue. So
wait, can we get a name of this note that's going to drop on the SoFi blog tomorrow morning?
The name of the note, Guy, you tell me who sings this song. Well, it's not really the song, but
the lyric.
Yes. Drop because it's hot. The lyric is actually drop it.
Oh, drop because it's hard. That's we talked about them yesterday. The Cypress Hill.
No. It's Chapel Roan.
Chapel Roan. I love that band. Yeah.
Hold on. It's really supposed to be more like drop it like it's hot.
Yeah. Okay. Then I have that wrong.
Which would be Snoop. Anyway.
Jesus.
Here we are, CPI month over month. This is headline including all items. So a couple of things that you can take away from this chart. Obviously, the bar on the far right side is the most recent read, and it looks pretty high compared to many of the previous reads. The other thing that you can take away from this chart is that there's kind of a pattern that emerges in the waves. And when the waves peak, you notice that January tends to be around that peak. So this is what's called the January effect. Now, we're not sure yet if that is actually what's happening here, but the January effect basically says, all of this data, although it's not in the titles and it's not usually talked about, is seasonally adjusted data. The January effect suggests that seasonally adjusting isn't working. So what it shows us is that inflation does tend to go up in January. That could be what's happening here. Also, something that we've figured out, Morgan Stanley did some research on this. Economist estimates and just Bloomberg consensus estimates are the most off in January than any other month of the year. So we usually get a surprise in January. Now, typically it's overestimated. This time it was underestimated, but this is what everybody got so upset about for about, 40 minutes today. And then we got over it. So let's go to the next chart. This is more about the January effect, just to show you kind of what happens. And this is something that we did as devil's advocate. Okay, is inflation a problem? Maybe it's not. This is showing us what happened in 2023 and 2024. And then the dotted line is the pre-pandemic average. This is just CPI reads throughout the year. This is not seasonally adjusted. Okay, so we take out all the margin for error there. What you see here, obviously, is January starts hot, and then gradually throughout the year, it falls. So if we follow the same pattern, this particular reading is no reason to freak out. That's basically the takeaway. And I don't know that the market is necessarily reacting because of this particular chart or this particular effect, but this is a good indication of let's just wait and see what the next few readings say.
Okay, so it's interesting, and throw up the next chart because this is going to be interesting, the distribution. But, Dan said something, and, I understand exactly what he meant. But earlier he said, if Fed expectations let's put it this way. I think even if the Fed lowered rates today, and this is just me, I still think 10-year yields are going higher. And Jeff Richards, you mentioned him, Dan, talked about this, and he said it on our podcast yesterday. He said he recently had a conversation, and one of the great mythologies out there is the Fed somehow controls interest rates. And, he's pretty convinced that that is, in fact, not the case. Clearly in the front end, but I think we're learning the hard way. They don't in sort of everything else. And that's what I think the market is coming to grips with. Anyway, so let's go to this, Liz, because I think this is really interesting as well.
Yeah. So then we get to the point where it's like, okay, maybe this is an anomaly. Maybe this isn't something to freak out about. How do we know when we should start freaking out? And this chart answers that question. So what we're looking at here in the red part of it is basically all the components by weight, not just the count of components, the components by weight in CPI that are still tracking above 2%. Now, we know that the Fed doesn't target headline CPI, but that's just obviously a good baseline to operate under. So all the components that are tracking above 2%, meaning the ones that are problematic, and everything in blue are the components that are tracking under 2%, so not problematic. The problem here is, you can see circled in that oval, is that the amount of components that continue to track above 2% is rising. So what we don't want is for that to continue rising, because that means that the problems are broadening. And if you remember what was happening, even since 2022, we had this whack-a-mole problem, right? We had used cars and trucks that seemed to be the real issue for a long time. Then we had food. Eggs were a problem at that point. They're a problem again. But it was always just one or two components, and we kept chasing them around. And then eventually, when those components got taken care of and stabilized, everything started to come back down. Lately, we've been concerned about shelter and about motor vehicle insurance. Make no mistake, both of those are still a problem. But now what we're seeing, as you can see on this chart, is that other things are popping up as problems. Some of the things that came up this time were rented cars and trucks, medical care. There are a number of other things. And when you look at just the distribution, it's not easy to find one particular problem anymore. There were a number of problems. So we want to see the proportion on this chart, the red proportion of this chart, come down over the next few months and over the next few quarters.
Real quick, Elizabeth, we have a question. The question is, what, and I don't know the answer to this, what causes the January effect?
That is a very good question. And the answer, frankly, is that nobody really knows for sure. We can speculate on a few things. First of all, it has changed after the pandemic. You can speculate that some discounting in the holiday season affects it. So you get these deep discounts November and December, prices go down, and then those discounts disappear in January, prices go back up. There's also a speculation, you could say companies have gotten comfortable, particularly post-pandemic, have gotten comfortable just passing their prices through. So January, we reset and they pass their prices, they pass all their costs through, prices rise, and you see this increase in prices. The other thing that I would submit is that I think consumers have continued spending post-pandemic much more strongly than they did pre-pandemic. So companies have been able to pass those prices through. And here we sit. So the January effect, again, nobody really knows for sure. It's difficult to measure, but it's a real thing. It happens almost every year. And it was happening pre-pandemic too. It just is much more strong now.
Right. So Guy, the drop it like it's hot. So she says Snoop Dogg. I was thinking of Chapel Roan. Okay. Feminine Nonanon or whatever the heck, that song? It says get it hot like Papa John.
No, drop it.
I thought that's what you're doing there. Let's focus a little bit on, I love it. Let's talk about some of the sectors we want to focus on here. You have a slide and you had a tweet. I think we still tweet, don't we tweet, Guy? Do you tweet ever? You're talking about monthly returns for sectors with the S&P during bear steepeners, and we're going to get into some specific sectors that you want to focus on in this environment. But, talk to us a little bit here, because, you keep hearing about a broadening out. I don't think Guy's buying it in the market. I'm not buying it. Our friend Doug Cass has been writing about it and putting a lot of data with it, other than just Guy and I yammering on about it. But you also have some thoughts in the current rate environment, especially where you think it's going. Where are some of the sectors you want to be and where you don't want to be?
Yeah, so this chart is just showing us on average how the sectors react in bear steepeners, which is what we're seeing today. What a bear steepener means is that yields are rising both on the short end and the long end, but the long end is rising faster. So today the 10-year is up more than the 2-year. So this just shows you what typically happens in bear steepening environments. You can see here most of the blue is cyclical. Right? These are cyclical sectors, economically sensitive. When things are growing quickly, those are the sectors that typically do well. So that is obvious. I think just thinking about it from a logical standpoint. And then all the way to the right, you see some of the more defensive or rate sensitive sectors. Now, why does a bear steepener normally happen? It normally happens because either inflation expectations are rising or because growth prospects have gotten better or are solid. You could argue both of those are true right now. So what we're seeing today is a bear steepener. However, the sector action today does not track this chart. We've got the best sector actually in this moment, consumer discretionary, second best sector, consumer staples. So that's almost opposite. I mean, consumer discretionary on this chart is right in the middle, staples obviously on the negative side. And then the worst performing sectors today, energy and real estate. So what's happening today, I think the market doesn't really know yet how to take this, doesn't know if they should take it as inflation is a threat or growth is okay. And we're seeing this flip-flop. And actually, this is completely different. This sector makeup is completely different than what it was even saying at 9:30 when the market opened. So that's just something to keep in mind for the long term. And another reason to not freak out yet, right? In a bear steepening environment, if it's for the right reasons, I think Guy would argue this is not for the right reasons, but if it's for the right reasons, the cyclical sectors are the ones that tend to do better.
Yeah, I would agree. And, Amanda made a nice little graph as to what to buy and what to sell in this environment. But yeah, I don't think today's print, at least, and it's anecdotal, I get it, but I don't think it's for the right reasons. I think it's for the reasons that everybody's been hurting for the last couple of years. So again, rates going higher typically suggests the economy's doing better, which is why you want to get into these cyclical names. I know, and I'm not saying it's different this time, Dan, but it certainly feels as if the move in rates is for reasons other than just economic growth. And I think the market, again, doesn't seem to care today. It hasn't seemed to care at all. My instincts suggest if yields continue to move the way I think they will, it's going to start to care in a meaningful way.
Yeah, I think we're already starting to see that in some sectors like home builders. And, we can go back and forth whether you want to use the XHB or the ITB. We're going to use this as the chart of the day here. Let's focus on the XHB, because to me, guys, sometimes I find interesting that this is not just the home builders and Masco, the suppliers, but there's a whole host of retailers. The largest holding in the XHB is Williams-Sonoma. And then you have Masco, which is obviously a big supplier, but then you have Home Depot, which is a different part of this sort of, trade, if you will. So let's just look at this. You see this is down about 17% or so from those. I think those were like 52-week highs, easily multi-year highs. And we just sold off a lot pretty hard. We tried to bounce a little bit. We're heading back towards that 100 level. But I think the most interesting chart is this 5-year log chart. Look at this uptrend. Look at how many times it's bounced off it. Look where it is right now. If we have yields going to 5% or higher, this is going to be a tough space to be in, Guy. And I know this is an area that you track here. Thoughts on maybe first XHB versus ITB, and then let's talk about some of the names that are within this.
Yeah, I mean, everybody looks at the XHB. I don't think it's particularly well constructed, but again, it's not what I think. You have to trade what you have in front of you. But to your broader point, I think this suggests that, if we continue, this will be fine as long as yields stay somewhat tame. And when I say tame, obviously 425 on the downside, maybe 4 3/4, 480 on the upside is this band that I think everybody's going to be okay with. As long as nobody moves, we'll get out of here alive. But if we just start to breach that 480, I think that's when the market starts to pick up and say, wait a second, we're not seeing the commensurate economic growth. Clearly, inflation is a problem. There's going to be a slowdown, and the slowdown theoretically should be deleterious, great word, to this either one of these ETFs. And this trend line is in place. So if you're of the belief that rates are going to start to back up again and go down, then you know what? You buy this trend line and you trade it from the long side against it. If you think like I do that rates are going higher for the wrong reasons, you wait for a break and then you look for a potential move to the downside that we probably last saw in the fall of 2023.
Yeah, Liz, Guy makes a really good point. So if you were looking at the home building sector, and maybe Amanda can pull up the ITB because it really does look the same, but it's a much more pure play on the actual builders. This is down a bit more. It's down about 21% versus the 17%. If you made that a 5-year log, you'll see the same exact uptrend, and we're actually below it a little bit. So to me, what that suggests is that the actual home builders and the concentration of them are acting worse than a lot of the retailers in it. So if we do have rates that stay high or go higher here, and home building activity, we know there's a lot of weird dynamics going on there, let's say slows down a good bit, would you think though that some of these home improvement plays are probably better ones to do than actual home building?
You would think. I mean, today, looking at it, even just in the consumer discretionary sector of the stocks that I'm tracking, Home Depot and Lowe's are at the bottom of the pile. But what I think you have to think about here, I don't have this chart ready, but I've shown it a number of times, is construction employment. So what was happening when rates were high and mortgage rate, I mean, they still are, mortgage rates were a problem, and we thought that it was just transitory, is that a lot of the builders were offering deals. So you could get a mortgage, you could build a house rather than buying an existing home. And that's how they loosened up the market for a lower rate than what you would get if you just went to a traditional bank and tried to get a mortgage. They can't do that forever, especially if materials costs go up, especially if employment becomes tighter and they're trying to find more workers in order to complete these projects. But really what's been happening is that the number of projects in backlog, and we've shown charts on this too, the number of projects in backlog have gone down. So there's not as much sitting there waiting to be done. You just don't need as many construction workers, in which case the construction employment numbers start to roll over. Now, they haven't yet in that long-term chart that we usually use, but if they do, you want to, first of all, be careful for the broader labor market, but you would also be careful, particularly in this ETF.
Guy, that's a really important point. So we've talked about this construction workers, okay, and in and around that space. You're talking about government workers right now. We're talking about large integrated oil companies cutting folks. You're talking about, large mega cap companies like Meta. Trust me, if the use cases start to evolve for generative AI, all of these tech companies are going to be cutting fat. And one of the reasons they're going to be doing that is if they don't see a massive revenue acceleration based on the spend, what are they going to do? They're going to rationalize spending, and that means headcount first. So your point, Guy, about the potential for unemployment to get to 4 to 4, we're at 4 right now, to 4.5%. That's something that wouldn't take much of the slowing economy to get that going, or stagflation.
No, I'm shocked to be. Listen, again, I thought this would have taken place sometime late last year. Obviously, it's not the case. I don't know really what it's on the back of. You go through these numbers, you look at the revisions, you find yourself scratching your head. People talk about the strength in the employment. And, maybe there is this underlying strength, but then you start to break it down, the number of people that have multiple jobs. I mean, there's a lot of things obviously to like. There's a lot of things below the surface not to like, which brings us to the following that I like a lot because Amanda does a great job. The call of the day. I mean, look at this. Look at the graphics that she put together. This is Upstart, which, it's not my particularly favorite, but this is a stock that's given a lot of people consternation over the years, and I think a lot of people have done pretty well. JP Morgan upgrading it to neutral from underweight. You could say they're late to the dance, but quite frankly, who knows? I mean, the way this thing moves. So talk about Upstart, Dan.
Yeah, really quick. I mean, this was obviously a COVID darling. This was one that folks were just buying. And you guys remember that segment with, I think it was Power Lunch. There was some guy who's like internet famous on Twitter, and he was talking about all his picks. And you could have thrown a dart in, the back half of 2020, early 21 at any of these sorts of names, and you'd be up like 30% in a week or two. This is a digital platform, cloud-based, that use AI to make lending decisions, yada, 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 right? So this thing was left 4 dead. And you look there and you say to yourself, okay, well, 11, have this, banks have it a hold or a sell. You just lost one of those. Maybe it's kind of chasing some momentum. This company that does not make money. It trades at, very high levels of PE and price to sales and the like here. So, let's look at this thing on a 1-year basis, and then let's look at it on a 5-year basis. Okay. So you see what's happened here. It's up, from basically 20 to here it is at like almost 90 or so. And that's just since August. Let's look at a 5-year right here, because this is what I think is really interesting. You see that sort of bull market activity in 21. This thing was down 80-some%. It looked like the post.com sort of stuff. But let's move this forward, because there's other names that fit into this category. And I think we're going to find ourselves at an interesting spot. So Affirm, that's a 1-year, obviously also in the consumer lending space. There's a bit of a 5-year. So some of these things lost 2/3, 3/4, maybe more of their value. And then they're found their way back here in 2024 into 25. And then let's go over to Carvana. This is one that is truly shocking. That's the 1-year. Let's go to the 5-year. Look at that. I mean, it's just amazing, right? So that's a long chart right there. Now let's kind of play it forward a little bit. So Roku, and we could go through it some other time, maybe some of the fundamentals and the valuation and stuff like that. So this is Zoom. There's a 1-year. This is one that, again, might this be turning into, Guy, where we're going with this whole conversation, a bearish to bullish reversal here? First time above its 200-day moving average in a meaningful way, late last year. For a while, this is a company that's got a good balance sheet. They basically have maintained their sales. It trades at a really cheap valuation. Might it be an interesting bolt-on acquisition for a Cisco or a whole host of others? Possibly. Now let's look at a Roku. This was also a COVID darling. There's the 1-year, so it's come off the mat a little bit. Let's look at the 5-year. It's going to look familiar to you guys. Might that also be something that is kind of coming out from a bearish pattern to a bullish one? Guy, thoughts quickly here, because not that we're saying to chase this sort of stuff, but when you're seeing other behavior that kind of looks long in the tooth, maybe there's some stuff that could get going in if the market just kind of makes new highs and continues.
No, listen, and I think the bearish to bullish reversal is potentially some of the more powerful way, to trade when you catch it. And the one that really, to me, out of all the ones that you mentioned, is Zoom. And this has been, if you think about it, we probably, the downtrend of this probably stopped late in 2022, early 23, sort of flatlined to slightly lower. And over the last sort of, 6-7 months, we've been peeking our head back up. So this is one that, believe it or not, you buy it on strength. If this were to close above 85, then you start saying to yourself, you've seen this dance before. You've seen this act before in terms of the acceleration. So I'm with you on the bearish to bullish reversal. And, you mentioned that Johnson that was on with Tyler Mathisen. Yeah. Put up an Upstart chart, Amanda. Go back like 5 years or so. I mean, I remember when this happened because I happened to be watching that day. The dude's name was Mark Minervi, and he was on October, I don't know the exact date, 2021. Move your little cursor over to October 2021, and you'll see that he effing top ticked that son of a bitch like a boss. And when Tyler said to him, as Dan just mentioned, what does Upstart do? He feigned not being able to hear the question, which is it's a total Johnson move. What he should have said, Tyler, is, I have no effing idea what Upstart does, but the chart looks great to me. I would have had much more respect to him than try to sort of say, wait, I didn't hear you. I have a bad connection. Go F yourself. Sorry. Back to you.
All right. So really quickly, let's go back to Zoom. And then, Liz, I'd love to get your take on just from the psychology of this. Okay. But give me a second on Zoom here. So this is a company that is growing earnings and sales low single digits. So massive deceleration, right? Since that 2020, 2021. It trades at 15 times earnings. They have, you ready for this? 30% of their market cap in cash. So they have $7.7 billion in cash. It's got a $25.5 billion market cap. They have no debt. So on that, maybe 4.7, 4.8 in revenue, they're going to do GAAP net income of maybe $900 million. I mean, this is a cheap stock that has actually been able to kind of hold on to that business. Shame on investors who are willing to kind of move it up to 50 times sales or whatever it was in 2021. But I think there are some diamonds in the rough. And if they could get their act together and start talking about generative AI and how it's going to, benefit in any way, shape, or form. I just think it's interesting. I think it's a really easy bolt-on acquisition, and it would be accretive for most companies looking to buy it.
Well, so look, first of all, when people talk about quality stocks, right? There's a lot of different ways you can look at quality, but I don't know enough about this particular stock, but if everything that you just said is true, that's called a strong capital position. Okay. And if you're looking at quality and defining it as a strong capital position, if you're worried about spending, CapEx spending, if you're worried about rates staying high and companies being able to internally finance rather than having to go external to finance their growth, you want companies that are in a strong capital position. So these are things that you have to pay attention to. I think the psychology, however, has been that companies like Zoom are the ones that are in a bearish pattern are not making the headlines, or they're making the headlines because they were in a bearish pattern and they've been in that pattern for so long, people just sort of forget that they exist. The ones that are making the headlines are what's driving the psychology of investor behavior. And when you have a day where maybe there's a quick reversal in the stock market, a la this morning, everybody goes out and buys the stuff that is in the headlines, that's front of mind, and the psychology does not suggest that they should buy that sort of thing. I have a question for both of you. I know of an ETF that has a very similar pattern. So Amanda, help me out here. A 1-year chart on KWEB, KWEB.
Oh, look at you, sister.
And let's look at that. And then after that, do the same thing, pull it out to a 5-year chart. So the KWEB is the China Internet ETF. There's also FXI, similar pattern, but KWEB is a little bit more dramatic. Okay, so obviously peaking its head up. I think over a 1-month period, this ETF is up about 20%. So clearly there's been a lot of volatility on its way there, but peaking its head up. Now pull it out to a 5-year chart and you can see, right, it looks terrible. So if you were going to look at that as an investor, you'd be like, why would I buy something like that? It's obviously dead. But I don't think it is dead. And we obviously had a headline a couple of weeks ago that brought it back out of the cemetery. So these are things that not necessarily the same sort of quality that you were just referencing with Zoom. So I cannot vouch for all of the Chinese companies in here and say that they are in a good capital position. In fact, I'd suggest that they probably aren't. But this is a similar pattern. And when you're looking for value, you're looking for things to pick up that aren't at all-time highs. You have to pay attention to charts like this, even if they make you nervous.
Well, we don't rehearse these things, Dan, but what I'll tell you is I think Alibaba is the biggest holding in the KWEB at about 11% or so. And as you know, Dan and Elizabeth, Alibaba is the B in my tube, and that stock is up 5.5% today, and that's had a remarkable run and a close above that high that we saw basically in the David Tepper fall of last year. And I think we're off to the races, and I've said this for a while, so I am so with you, sister, on that bearish to bullish reversal.
Yeah, I actually prefer the KWEB to any of these individual names. Now, obviously, you're getting the alpha in individual name when you see a BABA move that way. BABA is already above that September or early October high, and there's a KWEB here, so it's kind of lagging. So, what does that tell you? That some of the distribution or some of the names within the KWEB are not performing the same way as an Alibaba or a Pinduoduo, which is PDD. So, this one to me does fit that category. You had that breakout of what looked like more than a 1-year range in September. It came back and almost round tripped that whole thing. That's when Guy was saying, and I know you were doing this, you were saying, I like BABA here for a whole host of reasons. Not, I mean, the fact that it trades at 9 times earnings down there and this and that, whatever. But if you're making a bet on the Chinese economy coming back, betting on the consumer makes some sense. This also has to do with the fact that supposedly Apple's going to be partnering with Alibaba to do Apple Intelligence in China. I get it. I'm not chasing BABA here, but I think you could probably start building a position in KWEB and playing for the breakout or the broadening out of the Chinese consumer trade. Guy, if it's Wednesday, not only do we get excited to have Liz Thomas on the program, but we do something else here on Market Call that gets you pretty excited.
Well, I mean, we had him on. Actually, we didn't have him on. We appeared on the FactSet podcast with John Butters a week and a half or so ago. But if it's Wednesday, it is Butters, Dan. And he's not, unfortunately, with us, but his work is.
Yeah, well, that would be John Butters. He is the senior earnings analyst over there at FactSet. He writes the Earnings Insight blog. You can have that in your email box, whatever you want to call it, factset.com/insight/subscribe. It drops on Friday mornings. John is covering, I think, an interesting topic here. We've talked a lot about the dollar strength. We've talked a lot about our country's growth from a GDP perspective. I think we were 2.8% last year, expected to be maybe 2.5%, doing a lot better than most other countries around the world. But with all this tariff uncertainty and the like, we have the potential for some of these U.S. multinationals to kind of have a difficult time abroad. And then some of the companies that are more domestically focused being hurt by higher input costs, right, for what they are importing. If these tariffs really do stick, right now we just have aluminum and steel, but we know that there are threats against Mexico and Canada with China staying in place. All right. So John is looking at S&P 500 companies with international exposure. So let's run through it. So those with international exposure are reporting higher earnings and revenue growth. So that's more international exposure than the S&P 500 companies with more domestic revenue exposure for Q4. I think that's interesting. For earnings, companies with more than 50% international exposure are reporting growth of 20.8%, while companies with more than 50% domestic exposure are reporting growth of 13.9%. Liz, help us make some sense of this, because you might have thought the actual opposite of this.
Yeah, well, I don't know how much of a contributor proportion-wise NVIDIA is, but some of the companies, there wasn't an alternative. So even if the dollar is strengthening, if you have international exposure, if there isn't an alternative to your product, you have a strong competitive moat, then other people are going to have to buy it no matter what. Now, we've gotten into a position now where not just earnings, but even these inflation readings, we're getting the last reads of the Biden administration. We're going to start getting the first reads of the Trump administration. So this may change a little bit, but I remember having the same conversation when we had a dollar strengthening environment. I think it was a couple years ago. We expected these multinationals to suffer, and they didn't really. So I don't know if it's the competitive position that continues to keep them strong, but if there are other competitors that come off the bench, out of the woodwork, whatever the case may be, that are not in the US, then I think this suffers a little bit. But so far, the US continues to lead no matter what happens with the currency.
You know, what's fascinating about this, if you had told me, okay, John's going to do something on international exposure versus more domestic, and given the strength of the dollar, I would have thought this would be completely flipped. So this goes to show you. Now, what I will say, and I don't know the answer either, but my instincts suggest this is really skewed because of NVIDIA. And I'd be fascinated to see if you backed out NVIDIA, how this thing would look. So again, it is a really interesting graphic for me, because I thought it'd be completely the opposite. But that's why John's work is so valuable, because you unearth these sort of hidden gems, Dan.
Yeah. And, he added that NVIDIA as a top contributor to earnings and revenue. And just on the revenue front, companies with more than 50% international exposure are reporting revenue growth of 5.9%, while companies with more than 50% domestic exposure are reporting growth of 5% at the sector level. And I think this is what you guys were just getting at. Info, tech, and communication services sectors are the top contributors to earnings and revenue growth for companies with more international exposure. The other thing I would just say is that those information, tech, and communication services are probably more communication services. They're just less exposed to the tariff situation, right? In general. So interesting stuff there. John Butters, he is the senior earnings analyst over there at FactSet. You can have his report in your inbox Friday mornings, factset.com/insight/subscribe. All right. Before we get out of here,
we got a quick question from Jaded. If you could put that up, it's a great name. Hopefully, that was on your birth certificate. Question to all, but this is more for you, Elizabeth, because you've talked about this. Is this the higher for longer the new normal? Is Elarion right? I don't know what he's been saying. And should the Fed move off their 2% inflation target? You have talked about the potential for them to move off it and what it potentially could mean.
Yeah, there's been a lot of speculation that they would move off of it. I believe in the last press conference, Jerome Powell even said very explicitly, we have no appetite or no intention of changing the target. I don't think they should. And here's why. I think that they should keep it where it is, because if they move it, they are basically admitting that they no longer have effective tools to get there. So, and I think that would cause a negative market reaction just in and of itself. Obviously, we're not at target, and we're not getting there anytime soon because things seem pretty sticky. And the only way that we would get there quickly is if we had a downturn, some sort of real cooling off in the economy and a problem, which none of us want to happen. So I think it's still going to be a slow go of it to actually get to target. They continue to say that we're committed to getting to target. It may take a while. Is higher for longer the new normal? define normal. I don't know what your time frame is for normal, but I do think that it's here to stay for a while, and we continue to get used to it. Last year was the big digestion phase of that, like I talked about before, pricing out all 6 of those cuts. And this year we're sort of getting used to, okay, higher for longer. How much can we absorb this, and where should we be looking as investors now that we've had 2 straight years of 20 plus returns? And I think that's where a lot of this rotation game has come from. The last thing I'll say about this is higher for longer in rates is different than higher for longer in prices. And as consumers, if companies continue to try to push this through again, if inflation stays high or even rises, if companies try to push this through again, I think consumer staples companies are not going to get away with it this time. And that's why I put on the do not buy in this environment consumer staples, because I don't think that consumers are going to take it like they did for the last couple of years.
Yeah, the only thing I'd say on this front, and I was in the camp, and again, I'm not an economist, I'm not a strategist, but like, for instance, if we were going to go into a period of higher GDP because of some of the efficiencies that are being made from generative AI, let's say like once we get by the hyperscalers, once we get by the picks and shovels and all the stocks that we've kind of seen go up and down based on these narratives, and let's just say this technology is adopted across all these different parts of the economy and we start getting greater productivity. And again, this goes back to our conversation with Jeff Richards and a guy named Gavin Baker, who's been on our pods in the past. He's a prolific tech investor at a treaties management. I think he tweeted out something yesterday that we might see a 5% GDP print on the back of this sometime in the next few years. Maybe, maybe not. If that was the case, then inflation, that target is not going to be stuck at 2%. It's going to actually have to be rejiggered if we are in a new world order. And I get it. It's different this time. You know what I mean? Those are not things that we want to do. But at some point, if we are starting to see this second industrial revolution or something like that, I mean, you could say that technology is deflationary, but there might be a new sort of paradigm that's being established. Who knows? I think it's worth discussing. It's a great question. All right, last thing before we get out of here. This is a name that is really interesting, guy. I think we made this a chart of the day. I want to say a month ago, this was Deere. This would be the John Deere. They make the heavy equipment here. Here's a 1-year chart. You see what's going on since August. It's been a series of higher lows and higher highs, some really big spikes. You wouldn't expect this sort of price action on a stock like this. They report tomorrow before the opening. The implied move in the options market is about 5% in either direction. The average over the last 4 quarters has been about 6%. Let's go to the 5-year chart for a second, because this is one of the reasons, guy, I think you made it chart of the day, is that really long consolidation that we've seen. It broke out, it checked back to the 200-day, got right up above there, made a new all-time high. What are you thinking on this one into the print? Because this is squarely in the targets of a trade war.
Well, it's funny. Last night I mentioned Louise Yamada, the longer the base, the higher in outer space, and she actually emailed me back and said how kind it was for us to talk about her work. And this is a classic, the longer the base. I mean, this has been flatlining for the last 2.5 years. Valuation is reasonable. The fact that we've traded down and bounced off the moving average is encouraging. Personally, I think it sets up really well. Here's one caveat about that. I just read that Kathy Wood just bought 29,000 shares of Deere for the ARK Innovation Fund. I don't know what's particularly innovative about John Deere. Maybe they're now, they've put like those, what do they call those screens, like those iPads on their tractors, and that's somehow innovative. I don't know, but that's me. But I think this one is okay here. I think you played for a breakout to the upside.
I'm going to take the other side of that, guy. I just think that if this is a company after the price performance that it's had, regardless of valuation, given their international exposure, I know we just did that with Butters as far as international exposure. I just don't know how, given the uncertainty about tariffs, that you could give or you want to give guidance that's over your skis a little bit. So with a stock at all-time highs, I would probably give pretty conservative guidance. That's just my 2 cents. But again, I get it. The technical setup looks really good. Valuation looks good. Some of that uncertainty about tariffs and trade, I'd probably kind of wait and see what they have to say. Liz, thoughts?
I was just looking up an old company called International Harvester.
Oof.
Anyway, so look, these companies, Deere, things like Caterpillar fall into those industrial categories and obviously are going to be very affected. I remember what happened to them back when the Russia-Ukraine war began, because that was what we called the breadbasket and farming equipment got threatened. So there is a lot of volatility that can go on in these. And I would actually steer clear because of trade war fears.
All right. Well, there you go, guy. We covered a lot of ground. Hey, where can people find Liz's blog that's going to
Some
drop
crazy like hyper
tomorrow
link type of
morning?
thing with
You can
hyphens
get
and
hers. There it is.
you know,
SoFi.com
guys, I don't think it's that hard.
/on-the-money.
I think it's pretty simple.
Let's go there. I mean,
do.
try it
I
out.
think it's pretty easy.
I bet if you went to the Twitter where Liz Thomas
Twitter,
has an
pretty
account,
simple to find
she
it there
tweets
too.
out all that stuff. It's probably on the LinkedIn. You can actually probably
That's
go Liz Young weekly blog report SoFi,
There's a
Liz
lot of
Young
different ways
Thomas,
to find
excuse
it.
me. There's
Yes.
some legacy Young stuff out there, isn't there?
Yeah.
A little bit.
There
we
is.
can just go to the SoFi homepage.
Yeah, or just
this is not hard to find.
so you can get your blogs right all in one spot.
Well, sure.
Okay.
Yeah. The tagline.
Same way you can get your money right all in one.
Get your money right,
Yeah,
all in one spot. By the way,
that's it. I gotta hop because I gotta go do CNBC's Fast Money. The 10-year auction I just saw from Peter Buckvar. It wasn't great. It wasn't disastrous. So we'll see how that affects the TLT for the remainder of the day. But that's it. I want to thank the aforementioned EYT, Dan, Nathan, and the audience for those great questions. And we'll be back tomorrow.
see y'all.